Every time an FOMC week rolls around, thousands of retail traders watch their portfolios get wiped out by false breakouts. They take the bait on a sudden upward wick, set tight stops, and then watch the glass floors give way. To survive this week, we have to ignore the noise and look at the hard data. The trap catches people because they apply outdated assumptions to a market that operates under entirely new macroeconomic rules. What worked when capital was cheap will actively destroy your account today. I utilize crypto whale radar to visualize institutional order flow and pinpoint the specific levels where market makers are layering their traps. Tracking that order flow points to a harsh reality about the wider market. The highly anticipated 2025 altcoin season is, at this moment, a mathematical illusion. By the end of this video, we will look at the exact data-backed timeline for when the next true altcoin supercycle can mathematically occur. But first, we have to navigate the current market. And doing that requires understanding the profound paradox between our short-term bullish order books and a long-term bearish macroeconomic environment. Let's establish the immediate technical baseline. Right now, Bitcoin is oscillating near the $76,400 mark. This 3-day chart shows a critical macro support floor sitting squarely between $72,000 and $76,000. If price action confirms a structural break below that $72,000 floor, we are looking at a high probability vacuum straight down to the $53,000 to $55,000 region. But before you anticipate a massive drop, look closely at the local price action. We just saw a highly precise bullish bounce execute exactly at $75,600. When we zoom into this localized view overlaid with the Fibonacci tool, we can see that specific bounce level aligns perfectly with the golden pocket ratio. It wasn't random. Following that bounce, the 1-hour time frame is currently printing a distinct inverse head and shoulders pattern. More importantly, there is a hidden divergence in the order flow. While the price went sideways over the last few days, the cumulative volume delta, or CVD, printed a lower low. A golden pocket bounce with an inverse head and shoulders and a dropping CVD gives us a textbook signature of hidden bullish absorption. Institutional whales are quietly accumulating at support. Market makers do not push prices randomly. They actively hunt concentrated pools of liquidity to fill massive orders without causing slippage. To find where they are hunting next, we analyze the fixed range volume profile to see exactly where the recent volume is anchored. Right now, the value area low is firmly holding as support at that same $75,600 level. As this support floor holds, we see a massive cluster of retail short liquidations beginning to pool just above the current price action. This thermal heat map of the order book reveals the exact institutional sweep zone. The most intense concentration of stops is pooled tightly between the value area high at $78,500 and $79,500. Now, contrast Bitcoin's micro setup with the rest of the market. Ethereum is struggling to break through heavy resistance right at the $2,400 mark. Solana is facing a similar ceiling, repeatedly rejecting resistance between $95 and $105. This points to systemic weakness across the altcoin sector. Taking the data together, the highest probability micro outcome is Bitcoin rocketing upward to sweep that $79,500 liquidity pool, while altcoins remain starved of capital. But we have to pivot to the heavy macroeconomic reality suppressing the broader market, and that reality is dictated by the Federal Reserve. Going into the upcoming FOMC meeting, the futures market is pricing in a 99.5 to 100% mathematical certainty of a rate pause. That pause means the Fed funds rate remains pinned at a highly restrictive 3.75% ceiling. Navigating the brutal contradiction between a bullish short-term chart and a bearish macroeconomic environment is exactly why you need to subscribe to Crypto Whale Radar. We analyze both sides of the coin to keep you on the right side of the trade. Trading these liquidity sweeps in a hostile environment requires flawless execution. You cannot afford platform lag or slippage when market makers hunt stops. That is why I exclusively use BingX. It is the platform required to execute these high volatility setups with precision. You can use the specific referral link in the description below to partner directly with the channel and set up your trading terminal. Following that link secures the highest available exchange bonuses and connects you directly to my personal trading support team. In a market completely devoid of zero interest rate tailwinds, utilizing a top-tier execution platform is the only reliable way to extract profit from these institutional traps. So why is the Federal Reserve mathematically forced to remain hawkish and keep traders trapped in these volatile ranges? Because the latest CPI inflation data printed shockingly hot at 3.3. Notice how macroeconomic bear markets only truly come to an end when the energy sector reaches a local top. The mechanism here is simple: capital drain. As long as energy costs force consumer inflation up, the Fed has no choice but to keep monetary policy restrictive. That restriction drains liquidity out of high-risk assets, like altcoins, and forces it to flow backward into lower-risk havens, like Bitcoin and the US dollar. As long as crude oil remains elevated, the Federal Reserve is mathematically prohibited from injecting the massive amounts of liquidity required to trigger an altcoin supercycle. Which brings us back to the true, data-backed timeline for the next altcoin season. If we want to know when conditions will improve, we check the Federal Reserve's official dot plot, their own projections for future interest rates. This visualization of the FOMC dot plot maps out a harsh reality. There is absolutely no expectation of a return to a 0% interest rate environment until at least 2027 or 2029. The data confirms that an explosive 2021-style altcoin supercycle simply lacks the mathematical foundation to occur in the current year. Instead of a euphoric rising tide, the reality of this market is a laddered Bitcoin escalation. The rule for this environment is straightforward: exploit Bitcoin's short-term liquidity sweeps to the upside, but do not marry long altcoin positions while interest rates remain high. But knowing exactly where market makers will sweep liquidity is useless if you don't know where to hide your stop loss. Click the video on your screen right now to learn the ultimate stop loss placement strategy and bulletproof your capital against the coming FOMC volatility. I'll see you there.